All right, let's dive right into this explainer and unpack a truly fascinating financial puzzle surrounding Ormat technologies. If you follow the markets, you know that every now and then you stumble across a company where its stock chart and its actual underlying financial reality seem to exist in two totally different universes. Well, that's exactly what we're looking at today. We're going to strip away the noise and look at the pure, unadulterated numbers to figure out what is driving this massive disconnect with Ormat.
So here's the core mystery we're tackling. How on earth does a stock surge nearly 60% while a business is actively losing cash? It's the ultimate clash between roaring market enthusiasm and cold, hard, fundamental reality. As an investor, when you see a stock taken off like a rocket ship, your brain automatically assumes the underlying business must be printing money hand over fist. But as we'll uncover in the data, the market doesn't always reward what's happening right now. Sometimes it's pricing in a hypothetical future that totally contradicts the present-day balance sheet.
Let's just start with the sheer magnitude of this rally. A 59.08% trailing 12-month return is an absolute monster of a breakout. If you had held this over the past year, you'd be sitting on some incredibly outsized gains compared to the broader market. It's exactly the kind of wild momentum that instantly grabs the attention of momentum traders everywhere. But the context here makes it even crazier. We're talking about a sudden, violent whipsaw. In 2023, the stock dropped over 11%. Then, in 2024, it dropped another 10%. So for 2 solid years, the market was heavily penalizing this company. And then, bam. In 2025, it rockets up over 64%. This wasn't some slow, steady foundational climb. This was a complete explosive reversal in market sentiment. And all that recent buying pressure has pushed the company's total market cap up to a very hefty $7.07 billion. We are not talking about some tiny microcap stock where a little bit of good news can double the price overnight. Pushing a multi-billion-dollar valuation up by 60% takes a massive influx of serious capital. Wall Street is pouring big money into Ormat right now. But here is where the plot thickens. When we look at the top and bottom lines, we see a glaring contradiction. Top-line revenue is growing at a really solid 12.5%, but actual earnings per share? They've fallen off a cliff, dropping nearly 25%. The company is successfully bringing more money through the front door, which is great. But somewhere between the cash register and the bottom line, severe inefficiencies are just devouring those profits. Investors are cheering for a company whose actual earnings per share are shrinking aggressively. And to make matters worse, the company has generated a negative $284 million in free cash flow over the trailing 12 months. Think about that for a second. This isn't just a weird accounting glitch. This is real, hard cash literally leaving the business. A multi-billion-dollar company with a soaring stock price is simultaneously bleeding over $250 million in cash. Section 1, Top-Line Growth versus Earnings. Let's look under the hood. So, despite pulling in nearly $1 billion in revenue over the last year, closing in right at $989.5 million, they are seriously struggling to let those dollars reach the bottom line. Look, generating $1 billion in sales is fantastic, but if it costs you $1.5 billion to do it, you aren't exactly building sustainable value, right? The top line is super healthy, but the translation into actual profit is breaking down completely. Digging into the margins, their gross profits are currently sitting at 29.19%, which is actually down over 13% compared to their 3-year average. This tells us the direct costs associated with generating their revenue are getting significantly more expensive. Now, their net profit margin has held somewhat steady, but that deterioration right at the gross margin level is a huge red flag. It shows their core operations are facing real cost pressures that just weren't there a few years ago. On top of that, their return on invested capital is sitting at a really sluggish 3.11%. To put that into perspective, if you can get a higher guaranteed return just leaving your money in a basic high-yield savings account than a multi-billion-dollar company can generate by reinvesting into its own operations, well, you've got a serious efficiency problem. That 3.11% is also down more than 7% from their historical average. The cash they're deploying just isn't working very hard for them. Section 2, Decoding the Premium Valuation. Let's see what investors are actually paying for this. Compared to its own historical baseline, this stock has become incredibly expensive. A price-to-earnings ratio of almost 57 means people are willing to pay $57 today for just $1 single of the company's earnings. Even for hypergrowth tech companies, that is a steep, steep price. And remember, those earnings are dropping. Meanwhile, the price-to-sales ratio is sitting up above 7, which is a sharp jump from its historical average of 6. So what does this actually mean for you? It means buyers today are paying a roughly 25% premium for $1 of Ormat's earnings compared to what they normally paid over the last 3 years. And they're paying an 18% premium for $1 of sales. The market isn't just ignoring the fundamental decay we just talked about. It is actively paying a massive historical premium for it. It's wild. Worsening fundamentals, but a way higher price tag.
Section 3, Financial Health and Liquidity. Let's check out their balance sheet.
Before we throw more numbers at you, just a quick refresher. The current ratio is essentially the corporate equivalent of checking if a household has enough cash on hand to cover this month's rent and groceries. If everything you owe in the next 12 months suddenly came due today, do you have enough easily accessible cash to pay it off? Well, Ormat's current ratio has dropped to 0.81. That is a 27% drop from its 3-year average of 1.12. Historically, this company kept enough liquidity to comfortably cover its short-term obligations and stay above that safe 1.0 threshold. But that safety net, it's completely evaporated. A ratio of 0.81 simply means that right now, for every single dollar of bills coming due within the year, the company only has 81 cents available to pay them. Or if we look at their even stricter quick ratio, it's at 0.71, so just 71 cents of highly liquid assets for every dollar owed. When you're bleeding cash flow and your current ratio dips below 1, things get incredibly tight, incredibly fast. And making matters a bit more precarious, their overall debt-to-equity ratio has crept up past 1.0, which is a 13% increase over their 3-year average. So they're taking on more leverage right at the exact moment their earnings are falling, their cash flow is negative, and their short-term liquidity is strained. It's a really tough combo. Section 4, the dividend and verdict. Let's bring it all together. Sometimes a struggling company will try to keep investors happy with a fat dividend check. Not here. Income investors aren't exactly striking gold with this one. With a microscopic yield of just 0.42% and absolutely 0 consecutive yearly payout increases, you definitely aren't buying this expensive stock for the immediate cash payouts. So let's summarize this entire paradox. We have a soaring stock price clashing directly against a really expensive valuation, dropping bottom-line earnings and tightening short-term liquidity. We've got a staggering 60% stock rally over the past year that completely erased 2 years of awful performance. Yet that massive rally happened while the company is burning hundreds of millions in cash, seeing its EPS plunge nearly 25%, and operating with less than $1 of short-term liquidity for every dollar it owes. Which leaves us with this final, absolutely vital question for you to chew on. Does the company's future genuinely justify paying a 60% premium while they bleed cash today? Wall Street clearly believes a massive turnaround is coming and is betting big on that future top-line growth. But as the numbers definitively show, until that revenue actually translates into real profit, investors are paying top dollar for a business that is walking a very, very tight financial rope.